morning, investor and corporate. Welcome to Digital Roadshow Year's End 2024 Performance Review. This session will run about 45 minutes, including Q&A. Company will start the session by 30-minute presentation, followed by 15-minute Q&A. During Q&A, investor may leave your question in the meeting room chat box or use raise your hand function. We will open your microphone so you can ask the question to the company directly. May I now invite NR Instant Produce Public Company Limited to start the presentation.
สวัสดีครับ Good morning everyone or good evening wherever you are. My name is Dan, CEO of the company, and Khun Penrai, CFO of the company. And we will start the presentation for the full year digital roadshow, including Q4 2024 company presentation. So our company, I think 2024 has been somewhat of a rocky year. I would say we're still very much focused on delivering a sustainable food experience. We've had a few lessons learned over the past 4 years in terms of where we want to be, and we've had to face headwinds in terms of around plant-based foods, around impact activities, but I still believe that our vision is true, and our mission, we're still very much dedicated to that, which is looking at a sustainable long-term. How do we build the food system in the long term as a stakeholder, and to continue to deliver shared value through quality food and then enriching the lives of our stakeholders. We're still aiming to achieve net zero by 2050, or hopefully earlier, and we're still very proud to be the first, and then the only now for the past 4 years, carbon neutral food factory in Thailand. Our purpose is to make food for generations, so not just our generation, but for future generations. And today we're going to go over, an overview of the company, financial results, a segmental look, and then our basically outlook. So there's some subtle changes we're making to the company in 2024. We're very much focused on being now an Asian food export platform. So basically from farm to manufacturing to retail. We still make a lot of SKUs, and we still export to 30 countries around the world. We have simplified our business model, focusing on omnichannel ethnic retail and ethnic food manufacturing across the world. We have still the same factories. So we've got 2 primary food factories and then 1 pet food factory. And we have a variety of different products. And we also participate in a variety of different exhibitions around the world. So in 2024, 28% of our revenue was derived from omnichannel Asian grocery or ethnic retail. 39% was from ethnic manufacturing. 20% from pet food. 7% from e-commerce, selling supplements in Amazon, and then 6% from plant-based foods. And we ended the year with almost 4 billion baht in revenue. By region, you can see a slight change now with Europe being the majority, the large part of our revenue driven by retail, Thailand, and then the Americas. If we look at the key events that happened in 2024, on the ethnic food side across our core business plan, in 24 in the beginning of the year, our new sauce plant was completed, and we got our food safety certifications for export just in quarter 3. In quarter 2, the second line production of our pet food factory was done, and we hit 80% full capacity utilization in quarter 3. Unfortunately, because our land lease was done, we also closed down our plant-based eatery called Alt Eatery. In terms of omni-channel retail, unfortunately, we had a delay in our NASDAQ IPO, so we're looking forward to that in 25. We opened up a new store in Greenwich. We'll talk more about that later. And then we entered into an LOI to acquire a new store in central London. In terms of omni-channel, we also had a divestment of our shares in Boosted LLC. So that it was a joint venture in America with a startup company called Boosted Commerce. And that had a significant impact on our company. I just want to spend a few minutes talking about that. So I think on the positive side, the impact was liquidity. So the deal was for $21.25 million US. We received $3.25 million US in cash. We received a $6 million promissory note. And it was a promissory note that's very tough. So it comprised of interest payments every 3 months, a cash sweep, 50% cash sweep every quarter, which would early repay the promissory note. And I'm very pleased to say that interest and a prepayment of almost $200,000 was received in last month in that regard. And we also did a share swap of $12 million into the startup. There was an issue in quarter 3 for transparency, where our auditor flagged that we did not hire an independent financial advisor to do a fair valuation of the transaction based on DCF. And hence that might have impacted share price. I would like to clarify this. In the beginning of this year, well, at the end of last year, we hired a second independent IFA. We already had one already, which we had hired, and they completed the work in September. We hired a second. They completed their work in the beginning of January. We had a meeting jointly with the auditor and the SEC in January. We clarified that in the first report, the IFA noted that the independent financial advisor noted that DCF was an inappropriate method of valuation of a startup. And the appropriate valuation methodology should have been precedent transaction based on a revenue multiple, which is, I think, standard amongst any startup around the world. If you think about OpenAI, how do you even value OpenAI on a DCF, right? Anyways, we submitted our quarter 3 accounts again, maintaining that we believe that the first IFA opinion was correct. The second IFA opinion also aligned with the first IFA opinion in saying that DCF was not the appropriate valuation methodology to be used to value this transaction, and you should be using a multiple of revenue. We believe that we should get a positive outcome in terms of the SEC and the stock exchange in validating these the accounts. So do stay tuned. And I can give an explanation from the company's perspective. When we did the deal 2 months prior to us closing this deal in September 2024, one of the biggest banks in the world converted $75 million of their venture debt into a 10% equity stake, implying a $700 million valuation into Boosted. we negotiated a 20% discount to this valuation event. And hence our valuation was at $550 million. And hence we swapped our $12 million in equity for $12 million of shares in Boosted at a $555 million valuation. And this company, Boosted, had raised $400 million since 2020. Okay, so we believe that it was appropriate. The valuation was determined prior to the IFA. The IFA validated the valuation with a range, and we had done it just 2 weeks after one of the biggest banks in the world converted their shares at a valuation that was 20+% higher than our share swap. So we believe that it was an appropriate valuation event, and hence we divested our shares. And stay tuned if you have concerns around that. We also onboarded a new CFO as part of the Nasdaq IPO for Bamboo Mart. In terms of climate, we're still finalizing our net zero plan. There has been some adjustments. We're evaluating a few different vendors, and we're looking at how we can use forestry as a carbon sink for our net zero plans. Just from an ESG perspective, we continue to uphold our commitment to the 10 SDG goals that we've committed to across environment, society, and governance. We've received a few awards on environment, social, and governance. We had some comments before this, and I'd like to make some clarification. I think a lot of people don't really understand, I think, what governance means from a company perspective. And it's across the gamut, right? From a transparency, a reporting, a disclosure, a regulatory perspective. And that's separate from a business decision perspective. And then although I think we've made both good and bad business decisions, I think from a governance perspective, as you can see, we've been very transparent with everything. We've disclosed everything that we could. We've had shareholders meetings and board meetings to announce these disclosures and to clarify what had happened. We stand by what we've disclosed. And I believe that from a good governance perspective, we have followed best practice from a board process. So financial results, I will let our group CFO kind of take a run through this.
Thank you, Pak Dad. Yeah, for the year 2024, we have the sales. The total sales is 3.8 billion. It's a consolidated sales, which is 41% higher than last year. And then the gross profit is 1.1 billion or 13% higher than last year. And EBITDA is 529 million, is higher than last year, 61%. And net profit is 80 million, higher than last year, 246%. And normalized net profit, which we take out all the investment transaction out, such as the gain on the sales investment or the impair of the investment or something like that. And then the food will also, okay, I would like to say that this year the NRF, we have impact for the goodwill also. This one we take off, and then the normalized net profit going to be 105 million or 291%, increase from the last year. Normalized EBITDA is 555 million, and then 25% higher than last year. And as I mentioned, you can see this is the graph, as I mentioned already. And you can see the 13% higher, 41% higher than last year for the sales, 13% higher than last year from the gross profit. EBITDA is 61%, net profit 246, and normalized net profit is 70% year on year. Consider the revenue, we put on the fourth quarter. On the fourth quarter is 891, which is lower than the the last quarter นะคะ but because the first quarter we have divestment in the boosted e-commerce but still have in the last year. This is the reason นะคะ mainly and then for the total is a 2.9 billion for our consolidated sales for the year. I'm sorry for the 9 year. The total is a 3.8 billion นะคะ consolidated EBITDA is for the first quarter is 81 and then for the whole year is 529 as I mentioned. Compared to last year is higher than the last year. Net profit also for the fourth quarter is the loss 300,000 baht นะคะ but for the whole year is 80,000 gain the profit. Compared with the last year, the fourth quarter we had the negative for the 39 million. Which is improved, and then the whole profit for the whole year is 25 from the last year. And then for the performance, we can see that Q on Q and year on year. This one, as I mentioned, on the fourth quarter we dropped. The opposite is at 900, which is impact for the e-commerce that we have divested. And then for the third quarter is for this year is the highest one compared with the last year. The last year is the fourth quarter year highest one because that season. And see for the year on year as mentioned is 31% year on year is higher.
I wanna just add to this slide. I think one of the lessons as a young public company we've had is focusing too much in terms of appeasing both analysts and shareholder expectations from a growth perspective every quarter. And I think that had resulted in a lot of decisions I think we might have made or not made. And so I think we're definitely shifting how we think about growth. And I think that shift, number one, is definitely on how we grow sustainably, both from a leverage, liquidity, and an operational perspective. I think number two is I know every investor they want to see quarter-on-quarter growth. We definitely want to see it, but I think we're going to be focusing not just on quarter, but more importantly on full year growth. How do we achieve our targets on an annual basis? Definitely, we've got to look at how we can smoothen and grow on a quarter-by-quarter basis. But yeah, and most importantly, I think relative to historical performance, what will we be focusing on will definitely be on organic expansion. And that is how we continue to grow, focusing on our core business and then growing organically versus inorganically. And if there was inorganic growth, how does that add accretive benefits financially, operationally to the group?
Okay, for the gross profit, you can see that gross margin is decreasing now due to the sales mix, and then the fourth quarter is dropped from the third quarter 31 to 19%. This one is mainly due to the divesting of the e-commerce, which is the boosted NRF or the e-commerce is higher, is highest the gross margin. And for the year, gross margin is 29 to the sales. Drop is the same reason because it pet food is an increase on the pet food, which is very high, and then increase from the retail. Both of this business sale is a lower margin than the ethnic food, so therefore it's pulled out the average with gross margin down to 29 for this year.
I think gross profit margin again will be what you'll see over. Our business is transformed over time, and I think as retail becomes an increasingly larger component, you're going to see that gross profit margin normalize at a new level. But what I can say is that as we focus on retail and manufacturing, we should form some kind of a steady state.
SG&A is turned around on the Q3 to Q4. You can see that one even in the Q4 we have like the spending for the SPAC, for preparing to the SPAC item. And then, but the percentage to revenue is at 19% for the fourth quarter is decreased from the last quarter or the last year, the same quarter. Significantly improved. We have good control on the SG&A. And then for the whole year is at 31%. But we can compare with the last year, 30 is rise up a little bit, 30 from 31 because of the year 24, we have a lot of the expense of the SPAC. As I mentioned, it's higher than last year. And EBITDA, same thing. EBITDA for the fourth quarter at 7% compared with the last year is higher than last year, but is lower than last quarter. And the 13% of the annual EBITDA is higher than the last year, 49%. Then we have on this one.
I think from a net profit perspective, we're definitely disappointed in our performance this year versus last year. I think one of the most important things we're dealing with is legacy investment that we made, which has resulted in accounting issues and impairments, even up to the full year, with full transparency. And that's impacted our net profit. But I think if you think about where we should be net profit wise, we have historically targeted, if you look back, between 5 to 8% net profit margins, which I think is the medium term outlook of where we want to be. What we need to contend with as a company is what do we do in the interim period as we contend with these impairments. And why were there impairments? And I, as CEO, I take responsibility. So in 2020 to 2021, when we first IPO'd, we did a lot of investments in plant-based and sustainably linked activities, which we felt was what was going to be a new S-curve and driver of growth for our company. So we invested, I think, more than $20 million into these different companies, hoping to drive plant-based manufacturing, as well as our drive to net zero, transforming our business. And this was all in response to basically customer demand, supermarket requirements, etc. What we found is a large amount of setbacks in the industry. And although I fundamentally believe, both on a personal and corporate and level, that this is the long-term future of the food industry, I think the short-term issues we had to contend with is a readjustment in terms of where these companies are. And then unfortunately, from an accounting perspective, they don't take into account the value of the company. They only take into account, from an accounting perspective, where the balance sheet is of the company. So for example, we have investments in a startup where essentially we've already written off the entire investment, but the company is still existing, it's still raising money, and it's still functioning. And so, and because of that, for those of you who don't understand what I've just said, we've had to, from an accounting perspective, take losses, a non-cash, non-operational related, one-time loss from a profit and loss perspective on our net profit line, specifically because of these investments that we've made. I believe that we've gone through the bulk majority of these write-offs. I think we still probably in 2025, to be fair, will still be contending potentially with how we deal with this accounting wise. But I believe that within this year, this should all been clean, right? And we've said many times, we hired some consultants and we set up this new plan. We'll talk about it more in a moment. That this is a new refocus on basically our core business. So if we look at on a segment basis, we took a deep dive. Our ethnic food is still going strong, 7% year-on-year growth. pet food basically grew 72% year on year. And I want to remind you that we started from zero, right? So the factory was only built in was only finished in the beginning of 2023. And then you can see here that the omnichannel retail grew significantly for the year. And if we looked at the year in review, I think some of these plans that we had in ethnic foods, we tried, and I don't think we did good enough. So number one is launching Korean-inspired products. I don't think that we did that well enough. Number two is launching more products focused on ready to eat. Number three, our marketing efforts. I think in Thailand we did well. In the UK and the US, we didn't do so well. And so for this year, it's going to be focused on how do we launch more products around our own brands, and how do we improve the ratio of branded revenue versus OEM revenue. Although I think in 2025, our OEM customers are signaling good growth for the Western OEM, but on the Asian OEM not. So we'll have to see how 2025 turns out. There are headwinds, as you know, if you followed with regards to what Trump is doing. Thailand is currently not on the retaliatory or reciprocal trade watch yet, I think. Let's see what happens with the Thai government, but let's see what happens. I think on a positive note, shipping and logistics is no longer an issue, with the Middle East peace. I think the focus of what we did in 24 will carry on in 25, as we still continue to focus on the same product developments and customers, and then continue to focus on the existing marketing activities, because we believe that it's going well and we're doubling down. In terms of pet food, I think overall we kind of achieved everything we wanted to achieve. I'll be honest, the only thing we didn't achieve well was a yield improvement, as we lacked sufficient working capital to really kind of like invest into cost savings program. I think we could have saved 20 to 30 million baht on expenses in pet food if we had done some more capex in terms of warehouse expansion, manufacturing efficiency improvement. We started from a production capacity perspective, our second line in June. We hit around 80% overall utilization in December. We might have a plan in 2025 for a third production line so that we can continue to grow our revenue. And then from the omni-channel perspective, I think from a year perspective, we planned a lot. We only managed to get one new plant open. I want to quickly go to that as we run out of time. So this is our cash and carry. We focus a lot, rather than on expansion of the cash and carry, on improving the existing one, and this looks, trust me, looks a lot better than what it looked like before. We worked a lot with some trade commissions as well. So this is where our cash and carry is, and this is our new shop called Mini C in Greenwich, just south of Canary Wharf. This is central London in Chinatown. We have an LOI to acquire a new site in this area. This is the outside of the new store. I don't know how much time we have. Right? I'll just do like, this is what it looks like. I know we're supposed to leave time for Q&A, but I just want to quickly show everybody. This is the outside. This is the inside of the interior of the store. I also want to show a very short video of that. Sorry, I'm in the picture. I just want to show people that yes, I do my job. I'm in London a lot. I probably spend half my time in London. It's a big focus of ours in terms of expanding our retail, and I'll show you why in a moment. We've learned a lot in terms of the data that we're collecting, what's selling well, why it's selling, who's buying it, etc. And so this is data that we would not have ever received because you only get it if you own the retail POS, as you can see here. So clean shelves, minimalist design. We focus on not investing a lot, too much into it, but just focusing on a nice, good customer experience. As you can see here, one of the drivers of why we do retail is to make sure that products that we manufacture are available on shelf. And so this is our sauces, this is our teas, and this is our vegetarian plant-based products. And this is Jimmy, our partner in the UK. So this is a key driver of revenue in the future as we continue to focus on how we can sell our own products. To be fair to our competitors, we treat all products equally. And so those who are willing to pay for shelf space or who are competitive will get good product shelving. And just because it's our product doesn't mean that we're going to be shelved in a good area, right? So the team is independent of NRF. They're managed independent of NRF. And we always tell them that you do your job and we do our job. And if you don't like our job, well, you do your job. So let's go to the outlook as we end our presentation. So in terms of where we said we would be in terms of revenue, we said that this is what we have in 24. This is where we wanted to be in 24, and this is actually where we ended. So we didn't get an additional factory in 24, which we projected. We did still, however, manage to hit our 30% revenue growth according to these details. From a net profit perspective, we targeted, I'm sorry, this is wrong. This should be actual 25. We targeted 1 cash and carry and 10 to 13 groceries. We ended the year with 1 cash and carry and only 1 additional grocery store. And we did not hit our net profit target. We only wound up the year at 3%. And but that 3% was based on core earnings delivery, a reduction in SG&A as mentioned, and then we had a lot of issues with impairment. We also did not hit our return on invested capital, and this is a large part due to liquidity constraints that we've had. I'll talk more about that in this next slide. So if we look towards this next year, I think we're going to still target sustainably 30% revenue growth for the full year. As I mentioned, we will not be focusing as much on the short-term quarter-on-quarter growth versus focusing that we deliver an annual 30% revenue growth. We're looking at divesting certain assets, and we hope to end the year end with only owned factories. From a revenue perspective, although we ended the year with only 1 store each, I think we're still kind of hopeful we're going to end the year in 25 with these targets, hopefully. I think we'll target net profit somewhere within the range of 4 to 5% based on core earnings and cost cutting, assuming that there's no further impairments, and still targeting 12.5% ROI. I want to end with the contingencies. I think what's important for us to achieve our targets is the ability to increase working capital credit back to normal. We had $20 million of loan working capital facilities with banks withdrawn in the past 12 months due to the debenture dues. Fortunately, last week we got our debentures extended by 2 years. So hopefully we can get that back to normal. Another contingency is an IPO of Bamboo Mart this year, 1 or more sales of our assets, of critical hires, and sorting out legacy accounting issues. I believe if there's no questions and answers, that's all right. If there's any questions, we're very welcome for emails to ir@nrinstant.com. You can message us on Facebook and NRF Thailand. anything you're wondering about, please message us, and we will be as prompt as we can in replies. If not, thank you very much. สวัสดีค่ะ
This session has come to the end. Thank you very much, investor and corporate, for joining the conference. If you do need further details, please feel free to drop us an email. ขอบคุณครับ